Dan Niles from Satori Fund joins us now. Dan, I want to get to tech specifically. I want to start with Europe, especially given the Liz Truss news this morning. Is that in a way positive for the market because there's a sign that, change is coming, or is it additional volatility that affects all sorts of companies, including an IBM, which called out Europe as an area of concern, certainly for Q4 and perhaps into next year?
Well, I think you're right, John. I mean, when you guys had me on the last time, it was the day of that horrible CPI print. And what we said at the time, if you remember, and the market was down in the morning and getting beat up, is that we think the month of October will finish up, and the odds speak to the fact that it should be up about 3% or so, which is better than normal. Because there's a laundry list of things that are bad, including what was going on in the UK. And so if any of those things break in the positive direction, the UK, Russia, China's zero COVID policies, liability-driven investment firms, what happens with Credit Suisse, Deutsche Bank, if any of that stuff breaks positive, that's going to be good for the markets. And so to your point, you're seeing the pound strengthen this morning. You're seeing gilts yields down a touch as well. So the market's clearly taking this as a good sign that there's going to be a little bit more fiscal responsibility coming out of the UK. And so our belief is that the market continues to have this bear market rally that we've been calling for. It continues at least until we see these mega caps report next week, because a lot of them, I mean, they're down a lot, don't get me wrong, but they're down less than some of the other names that are down 75, 80% in the tech space. And so if you have an issue with one of them, because there's a lot of optimism going into all of those reports for the most part, if you see something that's a little bit more Tesla-like versus a Netflix-like, you could have a big issue.
And yet, Dan, I mean, when AT&T is up 9% on earnings, IBM up 4%, not because things are, not as bad as actually a beat and a raise from IBM on some stability. How is that not fundamentally good news and not just, bear feed?
Well, yeah, I mean, that's definitely good news. But remember, that's somewhat company specific in that IBM's in the first full year of their new mainframe cycle. And so IBM typically tends to do well. If you look at IBM over the last decade, their revenue's done nothing but shrink. So I think you have to put that sort of in context. No tech person says, oh, I just got to own IBM over the last decade, right? That's been Microsoft, Apple, Google, the really loved names, Tesla. And so you have a much different setup for expectations in that versus, something else. I mean, we own Oracle somewhat for the same reason. We bought it back, I should say, this last week, because our view is that, okay, that's definitely not a name that's been loved. It's got a very low multiple, but they do seem to be actually gaining some momentum in terms of cloud infrastructure market share. So I think you have to put this in context of, if you're somebody that has very high expectations, you're at much greater risk of having your stock get clobbered off of earnings versus somebody like a Netflix, where the stock was down 60% year to date going into this. And they put up good numbers, and the stock rightfully was up a fair bit. And so I think you kind of need to separate that out right now. And don't get me wrong, we have much more longs than we have shorts, again, because we were expecting a rally in October. But I think you have to get very specific within that on where you want to take that risk. I'd rather take risk in names that, there's not a lot of high expectations going into this versus ones like an Apple or a Microsoft, where the PE is much greater than the market. There's a lot of optimism going in, and there's a lot of reasons you could see them coming in and saying, well, cloud infrastructure is slowing down a bit because Amazon sales over the second Prime Day weren't that strong. Or, there was a big pandemic beneficiary in terms of smartphone sales, and that used to be just at the low end to mid-range, and now we're seeing the consumer slow down at the high end, which to some degree you saw in Tesla's average revenue per car that they sold. So that's why we're being very careful into mega cap earnings next week, even though we have more longs than we do have shorts, and we think the market's going to rally in October.